Good afternoon. This is Bree Barisel. I am the Manager of Data and Market Intelligence here at ASA, and I would like to welcome you once again to our new 2023 Economic Webinar Update with ASA Chief Economist Dr. Kuehl. Dr. Kuehl will join us here in just a moment. ASA would like to thank its 50-plus supplier partners for their continued support of all we do here at ASA. Without this support, many of the programs and services ASA offers would not be possible. The same goes for our 40-plus sustaining supplier partners. These ASA member reps have gone above and beyond in their support of ASA, so thank you. ASA association partners are also a big part of the ASA family. Shout out to the Federated Insurance, the recommended insurance provider for ASA member companies, and to Dell Technologies, the recommended small business IT solutions provider for ASA member companies. ASA continues to partner with Carhartt and its Carhartt Company Gear program to offer all ASA member companies a discount on their first order through the Carhartt Company Gear program. If you're thinking about new uniforms for counter and warehouse employees and drivers, or some company logoed gear for office staff, contact ASA's Mike Mayaska for details on how to access this ASA member exclusive discount. The ASA quarterly market survey is offered to all ASA member distributor companies. Once a quarter, ASA will pose questions on hot button topics of great interest to our members. These questions have been generated by ASA distributor members, your peers, colleagues, and competitors. If you would like a copy of the results, shoot me an email. Also, the ASA Education Foundation and ASA University recently released a new book entitled How to Develop an Effective Training Program. This guide was written by ASA distributor members who share best practices on how to put together and execute a world-class employee training program. A copy of this book was sent to all ASA distributor members. If you would like an additional copy, you can email education@asa.net. And some save the dates for you. ASA Women's and Industry Division's Elevate 2023 conference is in April 11th through 13th in Charleston, South Carolina. And ASA Emerging Leaders Emerge Conference is heading to Savannah, Georgia on May 10th through the 12th. Stay tuned for registration details on both of these events. And here is my contact information for any additional questions you may have in regarding what I just spoke about. And if you have a question for Dr. Kuehl during today's webinar, please don't hesitate to ask it during the webinar using the Q&A function on your Zoom toolbar. And with that, I turn it over to ASA Chief Economist Dr. Kuehl.
Very good. So now I'm just trying to get into my exciting slides, and I think I can. Ta-da! All right, so here we go. Those of you who were just counting on seeing my smiling face in the video, I'm trying to be cognizant of the fact that I'm doing this from a hotel and I don't really trust my connection as much. And besides that, I have a face for radio, so it doesn't really benefit me to be shown. It's like I'd rather people just imagined what I look like. So where are we? It's the beginning of 2023. We're trying to figure out if there's going to be anything really different between this coming year and the last year. And frankly, economics doesn't really care about calendars, so just because we think it's a new year and a new month doesn't mean that anything else changed. But to be honest, there's been a tremendous amount of activity just in the last couple of weeks. And for the most part, it's really pretty good stuff. We're still digesting some of it, but like today, you got the new wholesale inflation numbers, and wholesale inflation was down more than we thought it would be. We were thinking maybe it would decline by 0.1. Well, it declined by 0.5. So it's not like it's dropping out of existence, but it's moving a lot quicker than we thought it would. Another even more interesting development is earlier this week, you had the beginning of the World Economic Forum meetings in Davos, Switzerland. Now, I know you all follow the WEF passionately. I mean, who doesn't? But honestly, it is a very odd organization. It has no real official function. This is not a research institution. It is not governmental in any way. It is really just a collection of people who have some interest or influence on economic matters. And so when the group gets together in Davos, it's finance ministers from around the world and economists and demographers and analysts, but it also has tons of celebrities. I mean, over the years, you've seen, such economic analysts as Brad Pitt, and you've had, it's like, why? It's just like, I guess they're economics groupies or something. So it's kind of an odd group, but what it does do is allow a lot of interaction and conversation between almost everyone who has something to do with economic forecasting and projecting. At the beginning of the week, you had some really somber commentary. You had, like, the International Monetary Fund came out with its report saying it's going to be a miserable year. We're going to see a serious recession. It's going to be really, really bad. 24 hours later, they had changed their assumption completely and said, nope, it's not going to be such a recessionary year. We're actually going to see progress by the second or third quarter. What? What happened in less than 2 days that would make you shift opinion? And you saw a lot of that coming from various quarters. And what it came down to was that as the conference began, people were starting to do their reports and they were saying, okay, this is what we're finding. And the consumers of these reports were saying, well, that wasn't what we were expecting to see. So maybe things aren't going to be as bad as we thought. So the jury is still kind of out as to what we think we're going to see in 2023, because we're seeing some really good trends at the same time that we still have some of those old negative trends to contend with. So now that I've completely covered all my bases, so no matter what I say, I've got justification for it. I've been showing this chart for a while and it's still accurate because what it tends to say is contradictory to the notion that we're going to have this horrible recession coming in 2023, because things like real business sales are still climbing and climbing fast. We're still seeing growth in industrial production. We're still seeing growth in real income. We're still seeing growth in employment. So all of those things that we would expect to see declining haven't. Now, the numbers are still a little low as compared to what they were in 2018, 2019. So we have not fully recovered from the 2020 debacle yet, but the trend is that direction. And it's not trending downward. So as we're going into 2023, these numbers are still tracking at a pretty respectable rate, and real business sales have actually accelerated. This is partly because the supply chain crisis is beginning to rectify, and you're now beginning to see retailers and wholesalers actually having the merchandise to handle demand. Demand has been relatively strong. It has kind of peaked in some areas, but in other areas it's still growing. So a couple of words about what we're going to look at over the next 2 or 3 slides. This is something that Armada developed about 4 or 5 years ago. And the guy that does our statistical analysis is a retired lieutenant colonel who used to be in the artillery. And he pointed out that as an artillery officer, accuracy was really, really important. And he developed a rather complicated, many variable system to track where these shells were going to go. He's applied that same technique to tracking the industrial economy, and our performance has been 96, 97% accurate from 1 month, 1 quarter to the next. So as we look ahead at what we think we're going to see on the production side of manufacturing, the numbers are looking promising, and you've actually gotten some behaviors that are encouraging. The chart on the right is back to basically October. The one on the left is November. We're working on releasing the December numbers probably in another week or less. two things that stand out. One, you see all the growth that we got in 21, and those numbers kept climbing and getting way above where they were in previous years. We hit the end of 2022 and began to see a slump. The slump has become less pronounced. So where we were expecting a deeper trough, as the October numbers would indicate, we didn't get as deep a trough, and the recovery has started a little sooner. So by the time you get to the end of 23, we're getting back to numbers that we had when you had a certifiable boom in 2021. So what that tells you at a glance is that we're hitting a slowdown. We're hitting a slowdown that probably started in fourth quarter, late third quarter of last year, began to turn even as we were coming to the end of that year, and is now definitely turning, not accelerating at a breakneck pace, but getting back into a respectable range. And if you look at it historically, it's even more obvious. I mean, we've seen these big drops over the years. Obviously, 2008 was a pretty miserable recession. What made it as miserable as it was is it took so long to recover. So by the time you were back to numbers that were even close to what they were prior to that recession, you're into 2018. 2020, sharp downturn, sharp recovery, getting back to numbers that we had not seen since 2017, 2018. We get another downturn that's kind of connected to last year, but it shoots right back up. And you're getting back into those numbers that would have been considered highly acceptable throughout 2016, 2017, 2018. So we're kind of going back to a pre-pandemic economic performance. If you look at some of the more specifics in all of this, and particularly those that apply to kind of the inputs into manufacturing, primary metals bouncing back very quickly, but still very, very low compared to where they were a decade ago. Fab metals don't have as far to go. They came back, saw a drop, kind of flattening out. So on the input side, the metal side, you're still seeing a lot of stress. And this is partly demand has been uneven. The supply chain has been compromised. There are geopolitical things that are affecting all of this as well, which we'll kind of get into in a minute. Automotive trends, this has been staggering. I mean, I've not seen this kind of growth in a sector, certainly not in automotive, in a long time. Supply chain related, a lot of pent up demand. We are dealing with things like the average age of an American car is 12.5 years. This is as old as it has ever been. And there comes a point where even with cars that are made to last a lot longer than they used to, people set about wanting to replace their vehicle. And that's something that is beginning to accelerate much faster from 1 month to the next. October, we saw the growth, but it flattened out. In November, a lot of that growth is continued and is just flattening out towards the end of this year rather than the beginning. Longer term trend, you can see how dramatic this is. I mean, the automotive hasn't dealt with this kind of growth in decades. I mean, you have to go all the way back into the 60s. So what is it that is driving some of this enthusiasm, and what is it that seems to have changed in the last couple of months? Basically, it comes down to the notion that global inflation peaked in November and December of last year. So we began to see signs of this even in early November. Factory gate pricing began to come down as measured by the producer price index. The supply chain was starting to rectify. It wasn't that it was basically problem solved. China was still dealing with its lockdowns, and even with the absence of the lockdowns, China's supply chain is still a mess. But companies looked elsewhere. They began to find alternatives, and we'll talk a lot about that in a minute. But companies found ways to get the material they needed without depending on China. Reshoring became a real thing. Production in Latin America, production in other parts of Asia, et cetera. So the pricing for a lot of products began to diminish. Commodity prices declined, not across the board, But if you look at things like oil prices were at 120, 124 bucks a barrel as recently as March of 2022. They're down to high 70s, low 80s now. That's a $40 a barrel drop. Copper prices fell and stayed relatively low. Steel prices are starting to come down. Lumber prices have come down. Not back to the levels that we may have been familiar with prior to the pandemic, but certainly off their peaks. Shipping rates have come down. The containers that were selling for 23, 24,000 bucks a piece dropped to 12. Granted, they used to be 6, so it's not like we've gotten back to the good old days, but it's still having some of these costs, and even consumer expectations for inflation have diminished a little bit. This has prompted the central banks to start changing their tune. And they're now talking less about big rate increases and now talking more limited, maybe a half point rather than 3/4 point. Recently, the Fed has been talking about a 1/4 point, saying we may not have to raise rates even as high as people anticipated. We'll talk about that in a minute, too. One of the challenges of trying to understand economists is that we are really, really bad at our job. Our job is to predict and forecast and prognosticate, and we're about as good at that as a weatherman. So when you listen to an economist, you need to listen for one key phrase that is almost in every forecast, and that is, we think this is going to happen if. We think this is going to happen if. It's that if you're listening to. For example, in the last 2 or 3 weeks, you had a bunch of fairly miserable projections from everything from the World Bank to the OECD to various types of think tanks. And they are all saying we're going to have a recession in 2023 if. And the big if was the central banks continue to push interest rates higher. So it was almost like the economists were saying, we're trying to send a shot across the bow of the central bank, saying if you keep on pushing as hard as you have been on inflation, you're going to have an impact on inflation as you thought you would, but you're also going to send the economy into recession. And the central banks have kind of been reacting. And all of a sudden, you're getting a more relaxed response. The Fed is talking about reducing the size of its interest rates and maybe even halting the increase. Same kind of message coming out of the European Central Bank and the Bank of Japan and the Bank of England. They're all kind of talking the same way. Supply chain issue in China is going to start becoming a little more manageable. At first, there was a lot of enthusiasm when they moved away from the lockdown and the zero tolerance policy, but the fact that China had been doing that for 2 years meant that its population was largely unprotected, where the US and Europe and pretty much everybody else in the world had basically benefited from herd immunity. The Chinese hadn't. We moved off of the lockdown strategy over a year ago, almost 2 years ago. So in that time, an awful lot of people got COVID, but they got the mild version of COVID. They got the mild version that made them very sick, but didn't put them in a hospital, wasn't fatal. When they got through it, they now had a certain amount of natural immunity, and we began to build herd immunity. So when we've had flare-ups of COVID, it hasn't decimated the population. China has had no herd immunity. So when they released the population from the lockdown, millions of people got sick all at once. So they're mostly going to survive. Most of the fatalities have been among the elderly and those who are vulnerable, but it's taken productivity out because many of these workers weren't able to get back to work. Presumably, they will start to within the next month, month and a half as people recover from their experience with COVID. We still have pretty solid job growth expectations. I had a question at a webinar that I did just an hour ago about what does it mean that you're seeing a lot of the high tech companies engage in big layoffs. And a couple of things to be aware of. One, the numbers are staggering, but the percentages aren't. Like Amazon, laid off 18,000 people, which is a huge number. except Amazon employs a huge number. This was entirely out of the corporate office of 350,000 employees. So it was a small percentage of the total Amazon workforce, 1.1%. And the main reason that a lot of these high-tech companies have done the layoffs is that they expected more growth than they got. They looked at what happened in 2020 and they said, everyone's going to do Zoom from here on out. No one's ever going to travel again. No one ever is going to go back to their offices again. No one ever is going to go to a store again. They're going to order everything from Amazon. It's going to be delivered. It's a whole new world. It's the new normal. We're never going to go back to what we used to do. Well, that was stupid because many of us never wanted to give up the way we used to do things in the first place. So as soon as we had the chance to go back to what we wanted to do, we did. And those expectations as far as growth were compromised. Another thing to recognize is that this is a layoff of a population that is able to resume their career pretty quickly. Of the 18,000 people that were laid off by Amazon at the corporate level, the latest data shows that about 90% of them got another job in less than 72 hours. So they're people in demand. They're IT. The demand for IT is huge. People preferred working for some of the big players, but now that they're not working for the big players, now that they decided they don't want to work for Twitter or Twitter doesn't want them to work for Twitter anymore, they go to work for somebody else. It's different than what you had in the 90s when some 26 million manufacturing workers were literally made redundant. Their jobs were replaced. There was no place else to go. The jobs had gone overseas. The jobs had been replaced by machines. The people that are being let go in the high-tech sector end up going to another high-tech sector rather than into the unemployment line. So this is something I've showed before. It's an updated version, and the attention really is to be paid to what's going on in the fourth quarter. We had an unexpected growth in third quarter. We thought we were going to grow maybe 0.5. I mean, the estimate was very, very anemic. We ended up at 2.9 because it's been updated even from this point when it was 2.6. So we were growing at almost 3%. Now the conversation is, were we still growing at that level in fourth quarter, or do we fall back? So about half are saying, I think we're going to go back to anemic growth, maybe less than a point. But for example, the Atlanta Fed has a program they call GDP Now, which is their estimate of GDP numbers going forward. They're predicting the fourth quarter came in at 4%. So on the one hand, you've got people saying, nope, less than 1. Another group saying, nope, it's going to be close to 4, almost record numbers. What the heck? What is determining this? And a lot of it is coming down to figuring out what happened with retail at the end of last quarter. The retail numbers at the last quarter are always very, very volatile because a lot of the spending doesn't come until the very last second. And I've talked about this before too. It's the old American male saving Christmas. We do a miserable job of picking out gifts for our significant others. So we give these people the junk that we found at the store because we were panic buying at the last possible moment. Those wives and daughters and moms, then they take that stuff back to the store and exchange it for something that costs 2 to 3 times what we spent on the original gift. If we thought we were being clever and gave gift cards, because nothing says, I love you, honey, we've been married for 30 years, buy yourself something nice. She does, and spends between 4 and 5 times the value of the gift card. So at the very last gasp of the fourth quarter, you have all of this retail spending as women go back to the store and get what they really want instead of the idiot junk that their husbands and fathers and sons bought them. So we may end up with a pretty good fourth quarter. Where does that put us in 23? Depends. Most of this kind of depressing, we will be in negative territory for 3 quarters, was based on continued inflation threat. And if the inflation threat started to ease in November and December, and we keep seeing numbers drop, I mean, the latest CPI came in at 6.5. It had been as high as 9.2. Wholesale inventory, or rather inflation, down. Even the PCE, which we'll talk about in a minute, that trended down. So if we don't get the inflation threat and the banks do back off, then these quarters won't be as anemic and we'll be back in the 2.5, maybe 3% range. So here's the issue, and I've talked about this a bit before as well. The Fed does not pay attention to the CPI. The CPI is a little artificial. It is based on this mythical basket of goods that a theoretical family of 4 theoretically buys. So if you have the right basket, and if you really have an actual theoretical family of 4, you can compute inflation because you add up everything they spent one month and then you add it up the next month and the difference tells you inflation. If that group exists. But right now, we have at least 4 major cohort shifts. Boomers don't spend like Gen Xers, don't spend like millennials, don't spend like Gen Z. So whose basket are you counting? The CPI ends up being a little inflated and it's not as reliable. So the Fed does not pay attention to it. The Fed looks at this PCE inflation, personal consumption expenditures. This is much more accurate because you're actually adding up what people spent. However, it takes a while to gather that data. The very latest numbers just came out about a week ago, and October showed PCE 12-month inflation trimmed mean, which means they're taking the highs and lows off, at about 4.5. So it's come down a little. The Fed would like it closer to 2. But 4.5 is quite a ways away from 6.5, which is what the CPI was saying. The challenge with the PCE is that the data lags. The latest data we have is October. So we don't know what happened in November or December or so far in January. We won't for another few weeks. So it's more accurate, but it lags. CPI is timely, but it's less accurate. So you sort of have to pick your poison. We've seen this play out for quite a while, and I've talked about this before as well. Corporate investment is still at record levels. We're seeing like $75 billion worth of investment. Now, the gold or the brown line, I'm not sure how it's showing up on your screen, but the one that's underneath, it has not been as robust. It's a little bit more stable, and this is kind of figuring for inflation because some of that extra money that was spent, that 75 billion, is accounted for with inflation, but it's still well above where it has been for 20 years. Most of that has been driven by automation and robotics. We talked about that before. People are investing in machines because they can't find people. So you finally reach a point where I can't find the worker I need. If I do find them, they're going to be ridiculously expensive, and I just simply can't afford it. So these are companies. I mean, in the past, most of this robotics automation investment was larger companies, probably Fortune 500s, Fortune 1000s. Now you've got those tier 1, they're doing a lot of investment, but tier 2 and tier 3 and even below, they're spending as well. I do a survey for the Fabricators and Manufacturers Association, and some of you are members of this. They have a quarterly study which has the worst acronym in the history of mankind. It's the FFJSCR. Just try to pronounce that, the FIFISTJR. It just doesn't work. It's the Forming and Fabricating Job Shop Consumption Report, and it's one of the few surveys of small to mid-sized manufacturers. One of the questions we ask is what their capital spending plans are. And when they have been confronted with potential downturns and things, they put off those decisions. And we'll get a lot of responses saying, we've put our CapEx off by a quarter or 2 quarters or 3 quarters. The very latest version, which I just did a week ago, almost 75% are on target for their CapEx. They're going to do it this quarter. Another about 10% is doing it second quarter. That leaves very few that have put it off. So everybody in the small to mid-sized business community is saying, I've got to buy this stuff. I've got to invest in the robots, invest in the automation, because I'm seeing demand on the horizon. I don't have the people to meet the demand. So this is the kind of thing that kind of belies the notion that everything is going to come to a screeching halt in 23. You still see a lot of business expansion. Another way that this gets measured, and you've seen this too, capacity utilization, which is a survey essentially of how efficiently you're using your existing capacity. The rule of thumb with utilization numbers is that anything between 80 and 85% utilization is ideal. If it's below 80% in your utilization, you have slack. You have machines that are not being used to their potential. You have workers that are not as productive as they could be. When you get over 85%, now you start to run into bottlenecks and restrictions, and you're having a hard time keeping up with demand. For the last 6 to 7 years, those numbers have been under 80. They have been kind of averaging between 72 to 75, occasionally up to 77. For the last 6 months, they have been at 80 or just a hair below. The very last reading was 79.9. So it's right at the bottom edge of what would be considered normal. When you looked at the data from the FFJ-SCR, we also measure capacity, and the capacity for these small to mid-sized companies was quite a bit less, but higher than it's been in previous years. It's right around 70. That's not unusual, because the smaller companies, when they take on new machinery, it takes them a while to kind of get it integrated and get it up to speed and make it productive. But the point is that this investment has been keeping companies in that range where they should be as far as capacity use. We've talked about this in different permutations as well, and that is this big unknown, the 3.5 trillion in excess savings. What are people going to do with it? This is money that's essentially left over from the 2020 stimulus and the fact that many people were not in a position to spend because the service sector had been shut down. We spend 65% of our disposable income on services. If you're in the upper 25% of income earners, it's 85% of your services. So much of that savings is in the hands of wealthier people. It's in the hands of people who make over 100K, over 200K. That's a lot of discretion. They can go in a lot of different ways. They can start traveling again, which they have been. They can buy things. But what things? Are they going to buy vehicles? Are they going to buy vacation homes? What exactly are they going to invest in? And what are they going to spend that money on? We thought we would see a lot more of it come out in the last Christmas season, but it really didn't. Housing has gotten hit pretty hard, but it depends on the sector. So again, it's been almost schizophrenic. Permits overall are down 10%. Single family permits really down 22%, but multifamily is up 11%. So people are not investing in single family. Mortgage rates are too high, prices are too high, but the demand for housing is still there. So it's driving multifamily. And when you see multifamily being driven, a lot of industry sectors actually prefer that to the single family. I mean, if you're an appliance manufacturer, yeah, well, if it's a single family home, you're going to sell a refrigerator and you're going to sell a stove and you're just going to sell a dishwasher. If it's an apartment complex, you're going to sell 500 refrigerators and 500 stoves and 500 dishwashers and 500 washer and dryers. So the multifamily sector drives a lot more activity than single family, and you also get a lot more turnover. So when you talk about the sort of activity that goes on with housing, once the single family thing is up, it kind of stays there. I mean, people don't change a lot until, of course, they decide to sell it. Multifamily, you've got turnover, and every time you have turnover, you've got the potential to add more stuff to that particular complex. mentioned earlier that we're seeing a bit of a decline with the Purchasing Managers Index, and I've talked about the PMI before. Part of it that's useful is that it's current, comes out every month, and it's accurate. Purchasing managers don't know enough to lie. So if you ask them if they're buying more or less PVC pipe, if they're buying more or less in the way of copper, they just tell you, they don't really, I mean, the joke is the purchasing manager barely knows what it is they make. Somebody told them to go buy more copper, and by God, they bought more copper. They don't really know why. They don't care why. That's not their job. So the other part that makes it powerful is that anything under 50 is considered contraction. Anything over 50 is growth. So you can see that most of the countries in the world now are in contraction. Not deep, not crisis level yet. They're still kind of in the mid to high 40s, but not trending in the right direction, with two notable exceptions. India and Mexico, and particularly India. India is hitting numbers that are in the high 50s. And this is a phenomenon that's linked to the supply chain. Mexico and India have always been able to make the products that are made by China. India in particular suffered from a miserable transportation system. We can make anything. Getting it to market is a whole nother challenge. The roads are bad, the railroads are bad, the ports are bad. We don't know how to get it to where it's needed. That was a big inhibitor. China had a better infrastructure. But now that China is dealing with all of its issues, that gap between India and China has deteriorated. And all of a sudden, India is a lot more competitive than it used to be. I had never seen as many Indian operations showing up for industry trade shows than I had in the last 6 months. They're all kind of like, hey, we've always been able to make this stuff. We have the same machines that everybody else has. We just couldn't get it to you. We're still struggling with that, but other countries have other problems, and we're becoming a lot more competitive than we used to be. Reshoring is a real thing. A lot of it is taking place in the United States. It tends to hug transportation routes. So wherever people have access to good rail, good ports, etc., that's what's attracting manufacturers. And some of it is just kind of hedging bets. I mean, the dependence that we had on chips was made pretty obvious in the last couple of years. 85% of the chips that we use for everything came from one company, Taiwan Semiconductor, and literally one factory. So it was very vulnerable. Well, Taiwan Semiconductor decided that maybe when they build a new plant, they should not put it someplace where the Chinese can bomb it, and it's in Arizona. Samsung is building one in Texas. Intel is building one in Ohio. So we're changing the dynamics of where we get things from, and that construction spending is boosted by this manufacturing shift along with everything else. We did about $1 trillion worth of reshoring in 2022. We're going to be very close to that in 2023. When you look ahead at oil, a lot of conversation about where this goes. We're going to set records next year, probably between 13 and 14 million barrels a day. We consume about 20 million, which is about 4 million less than what we used to do. There's a gap of 7 million. Most of that is made up from Canada, Mexico, and a few other Latin American states. We don't buy very much now from the Middle East or North Africa. We are still going to be very dependent on fossil fuels for a long time. The Energy Information Agency predicts that we are still going to be 75% dependent on oil, gas, and coal by the year 2070. So the electrics are not going to take over the world in a mad rush. They're going to continue to build their market share, but recognize that right now it's 2.6% of the entire US vehicle fleet is electric. So it is still minuscule. And you're just going to have all kinds of conversations about, which comes first, the charging station or the vehicles. The US has committed to a different approach to green than they were even 2 years ago. And if you were kind of tracking what was going on with climate change and all the rest of it, initially, and this was Europe as well, it was punishment oriented. If you keep on doing this fossil fuel stuff, we're going to hit you with fines. We're going to hit you with regulations. We're going to make sure that you can't do this. We're going to punish you for doing things that were not consistent with climate change. That rarely works, because what you end up doing is forcing companies to find every way in creation to get around the regulations. So about a year ago, everybody shifted direction and said, let's quit beating people up if they don't move towards climate change friendly production. Let's reward people if they do. Let's create incentives and subsidies and all of this kind of stuff. And lo and behold, when you start to introduce the potential to make a lot of money, suddenly companies get really interested and said, if you're trying to punish me, I'm going to get mad and do everything in my power to get out from underneath this punishment. If, on the other hand, you turn to me and say, if you do this, you'll make a lot more money. Amazing how that works. My philosophy has always been follow the money. If you want somebody to do something, pay them. Why that is not just universally understood. I mean, it's the relationship we have with our workers. It's like, hi, I would like you to work hard for me. How about a raise? I mean, it's just it works that way, but so often we get in our own way, and I could go on a rant for hours, but I'm not going to. So the transportation demand is changing, and this is one of those things that what's good for them is bad for the rest of us. What's bad for transportation is good for the rest of us. So they're seeing a bit of a decline, particularly in pricing for maritime and air. That means it's cheaper for the people who are using those transportation options. That big capacity shortage we had in trucking has basically eroded. We had 14 loads for every truck on the road at the beginning of 22, but that was before we had 80,000 trucking companies come into existence in less than a year and a half. There's no sector easier to get into than trucking. If you wake up tomorrow morning and say, I want to be a trucker, what do I need? A truck and a CDL. You get yourself a CDL license in a truck, and you, sir, are a trucker. And so you had lots and lots of people taking advantage of the high prices because of the capacity crunch. Well, there is no capacity crunch now. We're down to 4 loads for every truck when the ideal is 2. And now we're starting to see some of those new trucking companies cycle out, because that's always the pattern. Easy to get into, easy to get out of. And we'll probably see sort of a balance in capacity later on this year. So the last couple of things to talk about, and then I promise to shut up. Employment. We generally use employment, we being the Fed and all that kind of stuff, to determine whether or not the interest rate raises have done the thing they wanted to do. I mean, the adage is that central banks raise rates until something breaks. Then once they've broken it, then they lower rates to fix what it was they broke. And the way they determine that the economy has been broken is usually employment, except we can't do that now. The employment numbers are just weird. The biggest challenge with workforce participation is retirement. And it was one of those things that we really should have prepared for a lot sooner than this. By 2030, every single boomer will have reached retirement age. Every single one. 74 million people out of a population of 330 million. That is a big chunk of the population, and they're leaving the workforce. Boomers were notorious for working past retirement age, but now the older boomers are in their 80s. And, it's one thing to work into your 60s and 70s, it's another to work into your 80s. So that cohort has to be replaced. We also have the gig economy to deal with, where we don't really know what people are doing for a living. The household survey is a way that we determine unemployment, and it's simply asking a household, is there anybody working in the household? Most of the gig workers say no. So if you're driving for Uber and Lyft and DoorDash and all the other stuff, and someone says, is anybody working here? No. What do you mean you're not working? You're driving for, it's not a job. If I don't choose to do it tomorrow, I mean, there's no boss to respond to. I mean, it's just my choice. I can stop doing it right now. But you're not going to. Well, no, I need to make money. So you have a job. No, I don't have a job. Which is it? Are you either working or not working? I can't tell. And we don't have a good way of counting that gig worker. What happens with wages, however, is worrisome from an inflation perspective because once they go up, they don't come down. It's going to be good for the consumption part. People will have more money, but it's harder for companies because not only are they having to pay more to recruit, they have to pay their existing staff more to keep them from being poached. So watch the labor increase because right now it's increasing by about 5.5%, which has been less than inflation, but inflation just fell to 6.5. So now they're getting really close, and the leverage that belongs to the worker is higher than it's been in a long time. So my last slide, I promise, is kind of the where do we think we end up in this year and next. Most of the assessments are saying we've got through 2020, miserable recession, weird recession. We got through 21, where we had the remarkable growth on top of that weird recession, growing at almost 6%. Now we settle back into a pattern that should look really, really familiar. Because if you look at the numbers, it's right back to where we were last decade. The numbers looking like we looked in 2014, 2015, 2018, 2019. So we've kind of gone through two very anomalous years, and now we settle back into a pattern that is very reminiscent of where we've been before. So personally, I do not see a real recession. I mean, I understand that this is a semantic thing. The joke used to be that it's a downturn if your neighbor loses their job. It's a recession if you lose your job. It's a depression if the economist loses their job. So I'm kind of leaning towards the downturn part where it's going to be a kind of anemic quarter or two. But even by the end of second quarter, we are probably going to see some pretty significant growth. And with that, I'm going to shut up. I tried to put everything together in one chart just to simplify everything. So there you go. Everything you want to know about the world economy just in one place, just nice and simple. And with that, I'm going to hush.
Thank you, Chris. I know you have another webinar to catch, and it looks like we have two questions. Let me get this up. The questions are, do you see any more interest hikes from the Fed?
Probably one, maybe two moderate ones. I think the Fed will probably do a quarter point increase early in the next month or so. But that may be it because they're already signaling that we're backing off. They were talking 3/4, then half point, now they're talking a quarter. And even some of the hawks within the Fed, like Patrick Harker, are discussing we may have done enough. So I don't see a lot of activity. I don't think the Fed is even going to get up to that 5% interest rate level that people thought they would last year.
Thanks. And the last question we have is, so at this point, we may experience a mild recession B2C, but only a slowdown in B2B.
Yeah, I think you're probably going to see a little more lively activity even on the B2B side because businesses are still trying to kind of readjust their supply chain expectations. The biggest challenge for a lot of businesses is that a lot of the stuff that they were expecting to get last year came in late and they don't quite know what to do with it. It's created big inventory overloads where companies are like, well, we didn't know what we were doing exactly and the supply chain was all screwed up. So now we have 500 million widgets and we have no idea what we're going to do with them. So there's going to be a sense of how do we get rid of this extra inventory even as the new inventory starts to come in. As long as the consumer demand remains fairly robust, and with that 3.5 trillion, it could, we just have to figure out where that cash is going to go. I mean, are they going to, just looking at the experiences I've had this last year, When I was at some of these fancy resort hotels early in 2022, there were no tourists. I mean, it was all convention attendees. I'm at the Ritz-Carlton Golf Resort in Naples. There's a conference here, but you wouldn't know it because it's completely dominated by people here to golf and go to the spa. There was some kind of a big raffle thing a minute ago where they were serving champagne, and there had been 300 people there. And it's like, so the poor slobs that are wearing their little name tags around are kind of in the minority, which we weren't a year ago. So people definitely seem to be back in the travel mode.
Great. Thank you, Chris. That was a great webinar to begin the 2023 year. And so that's a wrap. And on the weeks that Dr. Kuehl does not do his economic webinars, he produces a 5 to 10 minute podcast for ASA members, Keeping It Real with Dr. Kuehl. And you can catch that on all podcast platforms. So thank you again and have a great day.
Thank you.